So joining me up here today, I have Nikos Kavalis, Managing Director at Metals Focus, based here in Singapore. We have Spencer Cole, Chief Development Officer and Chief Financial Officer at Xanadu Mines, and Wayne Gordon, Senior Investment Analyst, Chief Investment Office at Global Wealth Management at UBS. So thank you for joining me today. And yeah, as I said, let's keep it conversational and maybe hopefully interactive with the audience. So let's kick things off just looking at, the macro outlook for the precious metals market. So, where do you see pricing moving? What are some of the big influences on the markets these days? Maybe Nikos, if you want to kick us off.
Yeah, sure. Look, I think like many others, we've been surprised at how resilient gold has been in the face of rising yields, rising real yields, and I think probably the explanation for this is in large part the very strong central bank buying that we've had, also some buying from, let's say, the more structural long-term private investor flows. Having said this, I think it's hard to avoid some further correction from current levels, considering it's looking increasingly unlikely that we'll have interest rate cuts from the United States anytime soon, possibly not until well into the second half of next year. So yeah, our view is, let's say, moderately cautious, but acknowledging the fact that as central banks continue to buy massive amounts of gold, let's say the bottom is cushioned quite well.
Anyone else want to dip in?
I guess I can. Yeah, I'd probably echo some of the sentiments that Nico has given there. The couple of key assumptions that we make is that the Federal Reserve will begin to cut rates by the middle of next year. We think that, and for the sake of the dollar strength that we're experiencing right now, we think the peak of negative sentiment in Europe will move past us in the fourth quarter. We do think that the US will slow down next year. We think the US will have a relatively soft landing, but we do think that it slows down. And so we do believe that the euro dollar will begin to rise. We'll see a euro dollar around the 112s, these sort of marks. I think the crucial thing is that probably the sharp slowdown we've seen in inflation, particularly with oil prices starting to pick up again now, we think that probably the easy declines that we've seen in inflation could be largely behind us. We think it's a slower grind lower. So hence the reason it's key that the Federal Reserve begins to adjust rates, because you see real interest rates will peak. But we think that you will get real interest rates to peak in the fourth quarter at some point. So the dynamics for us are a very range-bound market for gold over the next few months, supported by central banks. We think that central banks buy about 700 tonnes on an annualised basis this year. Obviously, that's down quite a bit from the 1,100 or so tonnes that they bought last year, or a little bit higher. But it's still, I think, and Nico does the data for this, so he has the inside word. But I think that's still the highest level of central bank buying since the mid-60s, or at least when we're collecting data. And to us, this is not a structural change that's occurred overnight. Central banks have been buying now over the course of since about 2010, 11, and they've continued to buy. It's just that the Ukraine war has ramped up their purchasing, and this has led to many central banks, even here in Singapore, wanting to somehow sterilise dollars, diversify their holdings of currencies, and gold is in part of that mix. So those things, as Nico said, protect us against what is a pretty unfavourable macro picture for gold right now. But that macro picture should improve for gold as we go through from the start of 2024. So we still think that you'll get a gold price around the 2,200 or so by the time we get into the middle of next year. So for us, from an asset allocation standpoint, it's still a good hedge. It's a good way of diversifying your dollars, particularly if you're, been big buyers of investment grade credit, where we've been extending duration on our credit in our portfolios. Such a good hedge against those dollar risks that we think that are still there and present, particularly as we approach the end of the year where it looks like we're going to have another debt ceiling issue. So these sort of things are good hedges in that context. Yeah.
I'll go ahead and
sure.
defer to these gentlemen on that topic. Happy to talk from a corporate perspective. We take our gold price forecasts from both of you, frankly, when we take our own view.
I feel for you greatly.
When we take our own view, we're just looking at really big picture things. We're not trying to work on the technical aspects of it, and so what we're thinking about is, well, what is, at risk of touching on a different one of your questions,
Sorry.
gold as a hedge is really something that ties into the broader theme of critical minerals, and the fact that that's going to create a fair amount of disruption economically and technologically around the world. And as a result of that, that's going to really increase the need for gold and the drive for gold. And I guess have a bit of a view that gold has an opportunity to be pushed forward as a result of that, maybe beyond what traditional technical analysis would suggest.
Does anyone want to follow on from that, looking at gold's role as the energy transition does kind of continue to take place, and what does it mean for the industry?
I think I'd probably pick up on it from more a macro perspective, that the transition economy is going to see inflation generally being a bit higher than what it's been over the last probably decade or so, not including the last couple of years, obviously, because things have normalised somewhat. And although gold's relationship with inflation hedging has been a bit of a love, it's a she loves me not type relationship, I think it's also the fact that geopolitics will, within this energy transition, part and parcel of the energy transition, geopolitics is also a greater issue. And in that context, and the one thing that we've seen over the last couple of years is the change in view of not just central banks, and which has been a sort of a longer term thing, but also asset managers in how they're managing their dollar risks and so forth. And so I think that, if you box all that together, higher inflation or more elevated inflation for longer, maybe not at the levels we've seen the last couple of years, but definitely it adds to the inflationary pressure. People are going to continue to look for these, at least pseudo hedges against these inflationary pressures. And I think we have a greater sort of underlying demand for gold as a result, from not just, the central bank community, but also from the financial community. Yeah.
Yeah, the other point I would add to this is Wayne made a very good point that there's like a paradigm shift in the way asset managers look at gold. 10, 15 years ago, cost of carry was such a deal killer in terms of certainly hedge funds, or particularly, in fact, medium, longer term asset managers that felt that they were basically losing out with every ounce that they owned. They were losing the opportunity for yield. And I think there's far more comfort in losing that risk-free reward. And if you couple that with the explosion in outstanding liquid wealth, you have this scenario where your 2, 3, 5% diversification allocation to gold, suddenly becomes a very serious amount of metal.
Do we have any questions from the audience before we continue on? Not yet. All right, no worries. So, I mean, I thought we could look a little bit more about this idea of the central bank purchasing, because it has really kind of dominated a lot of the discourse around the gold markets right now. So, why do you think that is? Is it because we're in this kind of economic instability period? Yeah, what's kind of driving that?
I think just from our side, the tipping point that we sort of see is that there's a couple of trends going on here. While sort of foreigners' absolute holdings of US Treasuries, as an example, is actually relatively, well, it's come down a little bit, but it has been relatively stable. But the mix of who's holding those positions is changing. And we've seen a couple of key buyers of US Treasuries over the last few years actually running down their balance sheets of government bonds in favour of alternatives, and one of those alternatives has been gold. And that's actually seen, and not only that, but also given the level of dollar strength we've seen over the last few months and actually prior to that, people have wanted to find that diversification to inevitably, when fundamentals kick back in from a trade balance perspective and a fiscal balance perspective, as the dollar reflects on those things longer term in the US. And so the idea that the US dollar can stay as strong as what it is over the course of a cycle, I think is probably the wrong assumption. And I also think that the war in Ukraine, as I mentioned before, the sanctioning of central banks changed the dynamics of how the world saw the impacts of these conflicts. And so that was in part the reason why we saw a significant pickup in purchases last year, which in fact, credit to Nikos and the team at Metals Focus who showed that the IMF data was so far off relative to what was actually being purchased. And that in itself, that was because of some lags, I assume, and so forth, and Nikos would know more about that. But that shift to focus around the fact that gold has no credit risk, right? It has no counterparty risk. You can take your gold, you can sell it for the spot price on the day, and it doesn't come with any more difficult issues attached. And I think that in itself, and also the impact of inflation finally, after 10 years of not really experiencing inflation more broadly, this experience now of inflation being a little bit structurally higher, I think has led to a whole range of things where central banks want to diversify their dollars and also diversify their bond holdings. Yeah.
Yeah, I mean, what I would say is, I don't particularly like the term de-dollarization, because it comes with implications that the dollar is somehow losing its de facto reserve currency, which I think it's not happening at all at the moment. But there's no doubt that there is a shift. Reserve managers have been shifting away from the dollar, not just in the last couple of years, but really if you go back to the early 2000s, where I think if you looked at global foreign exchange reserves, dollars accounted for more than 70%. I think last year they were less than 60. By the end of last year, they were less than 60. And for sure, the sanctioning that Gordon mentioned has catalyzed, let's say, a acceleration of that trend for all the reasons that Gordon touched on. But we don't really see, we can't see any change in that trend anytime soon. There is a natural need for reserve managers to diversify away from, the de facto currency that they all have to hold, and there's not that many other options.
Right. Yeah, we have a question in the front.
Previously, there had been, I suppose, talk about the dollar no longer being the reserve currency, and possibly that being replaced by Chinese currency. I mean, based on where we are at the moment, I presume the view is that it's unlikely in the short to medium term.
I'm not keen on the word impossible, but I think we're close to impossible. That I mean, first of all, the RMB is not free floating, so you can't have a reserve currency or a major reserve currency that's not free floating. If you had asked me 10 years ago, I might have believed that we are moving towards a possible free float for the RMB. I just don't see this happening anytime soon. I think China, having seen what happened to the ruble when the ruble was killed on a couple of cycles, and has certainly sort of focused their mind on what can happen if you allow a free float. So yeah, on that basis, I just can't see a move to the RMB, and I honestly don't see a scenario within the next few years under which the dollar would lose its dominance. What do you guys think?
Look, they talked for a while about the euro replacing the dollar as well, and it was, you know, if you don't have a consistent management and alignment behind a currency, it's difficult for it to imagine it. And obviously, as you said, I agree with that with regards to the RMB. I don't see any other candidates out there.
I think the importance of the SWIFT trade system actually says to you how important the dollar is, because when the grain deal collapsed in the Black Sea, it collapsed for a few reasons. But one of them was that the Russians had continued to ask for the US or the developed markets to enable some key banks within Russia to again trade in the SWIFT system. And that's even though there was this discussion around the Chinese trading, the settling system that China offers, but the SWIFT system is still far more broadly accepted. And it basically is a dollarized system. And that says to you that the fact that they continue to ask means that it's important to have free and easy movement of goods and services between them and other countries. And that to me crystallizes the fact that it's and along with the reasons that both of you have pointed out, it's very difficult to see a convincing shift away from the dollar, even to currencies like the euro, for example, in the next decade or so, I would say. Yeah, because even the electronic settlement system, in the end, it's you look at, you know, even when it comes to crypto, right? So the key issue is you still got to convert it back to dollars to engage in goods and services, right? Yeah, you can do various things, but in the end, everybody wants a dollar conversion, and that to me will be pretty consistent going forward.
So what are the BRICS countries? I mean, they're having trade relationships with each other, trade relationships, and particularly some defense and commodities.
Yes.
So I can't imagine that they're still trading in US dollars.
Yes, they look. For example, China trades with Brazil in iron ore, and it settles it in, as far as I'm aware, settles it in CNY or vice versa in real. But nonetheless, Vale will still want to settle at some point in dollars, right? So because a lot of the services that it has to pay for actually are dollarized. So you take even if you're oil exploration, inevitably you have to get a company like Worley or someone like that to do some work for you, right? And they'll want payment in dollars. They won't want payment or they want payment in a currency that they're denominating in. And so while, you know, there was some discussion at the BRICS about this, you know, key members of, let's say, the G20, for example, key members of those countries some of them are very large oil exporters, right? Oil's traded in dollars. It's not traded in any. Now, it may be exchanged between two countries in the domicile of that, the currency domicile of that country, but inevitably it's converted back to dollars at some point. And that to me, and then even settlement, if you're writing trade commodity finance against a shipment of whatever, iron ore or whatever, inevitably you're marketing your risk in dollars. You're not marketing it in something else. And I think that's where you can't really square it up. I think it's very difficult to square it up in that context at this point. But that's not to say that there won't be, Australia won't sell iron ore to China, and it won't be paid for in Chinese yuan, and it won't be converted back to Aussie dollars. But in the end, at some point, it will be converted back into US dollars at some stage. Yeah.
All right. I wanted to shift a little bit to, this is probably more directed at Spencer, but kind of looking at the mining side and the investment into that, the industry. We've talked a lot about the macro level of the gold markets, but really, looking at the mine sites, what brings investors in? Where does the interest lie, at least as far as you can see?
What we see is that investors, and I guess I'm going to talk about corporate investors in response to this question. You can tell me if you'd like me to talk about something else. But we're at a conference, 121 Mining and Energy. These are small companies, exploration companies, and ultimately, if they find something, it needs to be developed, and an exploration company isn't always the right company to do it. At the same time, the gold majors do not do their own exploration anymore. And if they do, they're phasing it out. What they have exploration teams in place to do is to do M&A. And to do M&A, they're looking for de-risking of projects. They're looking for social license to operate. Don't be in a jurisdiction where there's a serious problem. Don't have community issues. And they're looking for, a regulatory environment that supports juniors. And one of the conversations that we often have in the jurisdictions we operate in is, if you don't have a regulatory environment that supports juniors, then you're never going to have majors in your country, in your jurisdiction. No juniors, no majors. And so they're looking for sort of those three things to be in place. And once they're in place, they'll move. At risk of bringing it too close to home to my own company, the majors were watching us, but they were only watching us until we de-risked the project to the right stage, until we demonstrated that the project was ready to go, and then all of a sudden, tire kickers turned into serious conversations.
Well, I'd just say that. So the thing we tend to invest in gold mining companies. I'm sorry to say this, but we tend to invest in gold mining companies at the bottom of a gold price cycle because that's where we see enormous value. And in fact, actually, late last year when gold prices had come down in around October, they started to move up again. There was enormous value in gold companies versus diversified miners, for example. And so I think, and not only that, but also one trend I've noticed with some of the larger gold companies now is they are also trying to diversify their own metals production. And in particular, Barrick are trying to increase their copper production and so forth. So there is that sort of movement to not just produce gold, but also think about some of the byproducts that have come out historically and so forth, and take that a little bit more seriously as well, particularly with this transition to lower carbon and the fact that some of these things are actually very useful metals. The key constraint I have on the mining side is investing in miners is that we put gold into a portfolio for a reason. And that reason is to hedge our equity portfolio, for example, because gold has sometimes, depends if you're talking about emerging markets or developed markets, it has half, if not a third, the volatility of those other assets that we would have been investing in. And so we see it as that. We see it as a hedge against dollar weakness, given that when you're talking about emerging markets, when you buy emerging market indices, you're actually buying them in dollars, right? They're hedged in dollars. So you want a sort of little hedge in there as well. And so miners have similar volatility to our equities, some equities, but they follow the underlying trajectory of gold. And so often, the reason why we often favour the metal over the companies themselves is because of that paradigm. But having that being said, as I said, there are periods when gold companies are showing enormous value, or gold miners are showing enormous value relative to diversified miners, and often it's to do with the difference between the gold price and the iron ore price, right? Because most diversified miners, one way or another, are linked to iron ore, right? And the key thing I find about this is, and this is what I find very interesting about some of the gold companies right now, if there's one commodity that's going to be have a supply-demand balance which broadly shows a surplus, I think over the next decade it's going to be iron ore, right? And so to hedge yourself in, because and the issue with that is if you're an investor in Australia and BHP is 12-13% of the index, right? So you can't avoid BHP, right? Otherwise you just don't participate in the index, right? But what you can do is you can introduce some of these other commodities which may not have the same supply-demand dynamics, and I think gold is very much one of them, to help you offset those risks. And I think that's how the whole investment side on the mining side is actually changing quite a bit. Particularly now you look at the China housing situation. Chinese growth has been underpinned by housing. That's done. That's the best we can hope for here now is stabilisation, right, in at least the next year or so. But inevitably over sometime between 2025 and 2030, the consumption of copper, for example, is going to be higher in China with respect to renewables than it was with respect to housing. And that brings a different dynamic into looking at mid to small cap miners. And I think your points about how some of the larger diversifieds are no longer exploration companies is broadly true. And you can see that with the M&A activity going on with the big diversifiers now, and even the bigger gold companies, as you say. Yeah.
Look, from my perspective, there's no doubt that people don't invest in gold mining companies because they're bearish gold, right? I mean, it's historically it's always been a high beta gold trade, and I think the challenge that gold miners, companies that really focus on gold rather than diversified, are facing at the moment is that we're coming out of a period where mining margins, gold mining margins, had been the highest that we'd seen in a generation, probably, right? Much higher than during the previous gold bull cycle, and a combination of prices are not sort of as attractive as they were, and most importantly, costs ratcheting up, is kind of putting them a little bit under pressure. Now, their saving grace is that a lot of them are operating in non-dollar jurisdictions, so the FX side of things is helping out. But if we're right and gold does suffer some liquidations from current levels, even if we assume that the dollar remains strong, margins should come under some pressure. So that might be a problem for the industry over the next 6 to 12 months. But look, beyond that, we're very much of the view that gold will find the bottom and better days are coming afterwards.
Any other follow-up from that? I'm curious to see, you know, there was a lot of talk about, you know, the majors kind of looking to buy some of the exploration companies. So what do you think makes for an attractive investment? Putting yourselves in the shoes of the majors, you know, what would kind of people be looking for?
I guess
Tough question, Spencer.
I have been in the shoes of the majors, as well as on the other side of that discussion. They're really the majors are looking to put things into their portfolio from a generally like an earn-in type perspective, and see what it's got, see what it could be, put their own expertise into it, and then if it doesn't work, they flip it, and they move on and keep going and going until they find the next opportunity that suits them. They don't want to. They're not going all in on anything. That's for the juniors to do. The juniors go all in, and have to prove that it's worth a major even touching it in the first place. So we're looking at potential. And when I was doing it, the other thing we were looking at is upside, right? What haven't they discovered yet? What's the exploration potential? And that'll drive you to put a focus on something that perhaps others won't.
Yeah, from the perspective of our clients on the mining side, where you are on the cost curve or where your acquisition will put you on the cost curve is very important. And I think you touched on it earlier. What social baggage your investment comes with is obviously quite important, because that could overnight turn incredible opportunity into a disaster.
Yeah, absolutely. Do we have any questions to kind of continue on with the gold topic before we do a quick shift over? Yeah, sure.
On the currency side of things, we've seen obviously the Japanese yen, gold has accelerated out of control. Within the US, for example, Bidenomics, they're now going to be taxing copper and gold timeframes. So how do you see the impact of the currencies between the two jurisdictions, and the dollar being a big part of the gold underlying pricing movement?
This with the yen and the dollar yen, yeah. So the dollar yen is effectively it's a rates trade between the US and Japan. Japan has made the BOJ has made some interesting comments over the last couple of weeks, clearly concerned about the ongoing depreciation of the yen. They're willing to, in the end, Japan has a bit of a love-hate relationship with its own currency. So the exporters have done tremendously well. If you're a person sitting in Singapore looking to go for a holiday at the end of the year, you think this is just tremendous. Even Australia's cheap now. But the Bank of Japan clearly have drawn a line in the sand somewhere, saying, look, historically over the last 6 to 12 months, that line was around 145, and they've intervened at those levels previously, at least softly. They accept that the global economy is slowing down, so that line sort of got lifted a little bit to around that 147, 148. And it's pretty clear from their comments the other day that if it goes above 150, they'll start to intervene again. But the interesting thing I find about the dynamics of the yen lately is that it's actually drifted away from its spread between the US, the interest rate spread between the US and it. And in part, I think it was because of I think when the Bank of Japan made that small little tweak where they said they'll allow the 10-year to go to around 8.8 to 1%, people were a bit disappointed that wasn't a more structural move by the Bank of Japan to get rid of yield curve control. And I think we've seen it drift as a result. And I think the comments the other day were founded in trying to set people's minds back to yield curve control can be adjusted in the future if inflation remains elevated and if growth remains robust. I guess from my perspective, again, this comes down to the direction of dollar yen now will come down to broadly what the Fed do. The Bank of Japan, yes, I believe they will walk away from yield curve control at some point, but I think that while the global economy is slowing, I think they'll be reticent in doing so. I think they'll probably leave it on for too long. But do I think that the 10-year in Japan will inevitably be at 1%? I think that's fair. I think that so long as the 10-year in the US is around the 4s, high 3s, I think that is possible that you see this sort of constant drift higher on the 10-year in Japan. And I think that's going to cap the top side. And then how quickly it comes down from there will depend on how aggressive the Fed is when it begins cutting rates. But, look, Japan, the growth environment there is actually much better than what it is in many other G10 countries. And if indeed we finally have a positive inflation rate over the cycle, the yen can come down very, very quickly, as we've seen in the past, to around the 125s, 130s, right? And so that's how I think about it. For me, it's a 5-cent upside from here, risk, to a 20, 30 downside if the Fed was more aggressive as we go into the second half of next year. Yeah, yep.
The yen weakness has had some pretty interesting implications for the local bullion market as well. Historically, Japanese investors tend to buy low, sell high. So whenever you have a sharp increase in the yen price, you're pretty much guaranteed, or you would have been pretty much guaranteed that you would have disinvestment, like selling back of bullion. And we've seen this year this change quite significantly. Even though gold has been breaking through, in yen terms, all-time highs, you're still seeing robust physical investment, whether this is on the ETF side or through the gold shops or gold accumulation plans that you have in the country. And very interestingly, you've also had the emergence of a much younger gold investor in the country. So again, historically, it was always people in their 60s, 70s trading gold. Younger people couldn't care less. But we've seen people in their late 30s, 40s come in. And it's very much because of their worry about the Japanese yen and by implication, yen-denominated assets in the country.
It's about Spencer about gold hedging. What sort of strategies does a big gold producer employ in hedging, and particularly in this environment today where we've got this on the strengthening side, but also uncertainty? What would you advise?
I still have scars from 2006, 2007, when a lot of the big gold companies, including the one I was involved in, had a significant hedge book, and gold price skyrocketed, and everyone was scrambling to get out of their hedges before they went out of business. So in our decision following that was we're running unhedged forever. And to my knowledge, that company still has not done further hedging of gold. What investors told us when we talked about this was that they weren't buying a gold company for cash flow. They were buying a gold company for exposure to gold and the upside that a mining and exploration company can give you beyond just the metal. And so we were really adhering to what investors told us they wanted, which is that they didn't want us to be hedging. The hedging was done because a bank made us do that to get a loan. and we wanted to get out of it as quickly as we could. And so I would advise a gold major now, don't do it. Just don't do it.
What about junior? What about the smaller companies?
Smaller companies, I think. Look, it's a legitimate way to get access to cash if you need to, but you got to be careful. You can get yourself into a trap that it's hard to get out of. So it's part of your toolkit, but one that's used very sparingly.
So do banks generally require that?
Well, I was just going to say, I think I think from our perspective, we all learnt a few lessons in those days. I was sadly around at that time as well. If I wasn't, I'd be a lot younger, and that'd be nice. But now, from my perspective, when I'm investing in a junior, I just want to see proved resources and the length of that. And what gets me is, and I didn't realise this until I was looking at a smaller company in Australia, which I won't mention, but they had 7.5 years, right? And when they found an extra 2.5 years, like, you could not get a person to take a look at it from my side. As soon as they had 12 years, everybody was all over it, right? Because tremendous value at that point as well. And so I learned, firstly, we learnt with you guys, we learnt some similar lessons. But secondly, that proved mine life is one of the most important things. Because when you're buying a junior, and I think there's no illusion of this, when you're buying a junior, you're buying it for two reasons. Because you think they can deliver a higher grade of gold at not a lower cost, but a higher grade of gold, and they have potential for increasing mine life, which gives you a bit more vision to earnings going forward. But the second point is that you're hoping that a major will pick it up at some point, right? Like we've seen with not a small company in Australia and a much bigger major of late, right? And so that's why mine life for me is the most important part. But I'm not lending money to a gold company. I'm saying, well, I'm interested in that gold company because of this, this and this. So I come from a bit different perspective on that, yeah.
I think it also depends what we mean when we say hedging, right? If we're talking about hedging out to 5 years, like in the good or bad old days, whatever you want to call it, mining companies did, and then got killed one after the other. I think, again, the word impossible is not great, but I think it's very hard to see this re-emerge anytime soon, especially because of the shareholder pressure to not do that. But if we're talking about short-term activity, so, you wouldn't even call that hedging. You would call it price optimization or something to avoid the H word, right? But I think if you're looking, for example, at an Aussie company locking in a price for 3 months or 6 months, I think that makes more sense. And we are seeing a bit of that, particularly given where the Aussie dollar gold price got to. Also because contangos are really quite juicy at the moment. I mean, it's not. It's a nice screw, really, to be able to get a bit of extra when you know that you're gonna sell it in 3 months anyway. So why not get a bit of extra now? You might lose a bit of the rally, but
I think too that the mining companies have changed. So the investor expectations of a mining company has actually changed a little bit too in the last year. So in the past 3 years, some of the majors were preferred because they were generating some cash and they were giving those as dividends. And some of those dividends were some of the highest we've seen from some of the majors. But I would argue that the fact that some of the large diversifieds have come out and said, sorry, we've got to do growth and you're going to pay for that, and they've reduced the dividend payout as a result, but the market's actually swallowed that relatively well, better than I would have expected given how the previous 3 years has played out. And even though they're carrying enormous amounts of cash, they have been saying, you've got to buy into this growth cycle as well with us. Now, they've done it. It's been a very, very slow action, but increasingly our investors are now looking at those companies which have the strongest growth potential, not the strongest cash balances to pay that to shareholders. Because the transition economy is such a present thing in people's mind as they invest in mining today, your ability to grow resource life at a moderate cost has become almost, and I say almost, as important as cash distribution back to shareholders. That was not the case 2-3 years ago. You were paid to print cash and take it from a pile here, cut debt, give to shareholder happy, acts like it's a bond. But now yields are at 5%, 4%, cash yields are higher. People want miners to be also investing in quality growth, and that's changed just in the last 12 months. Yeah.
Do we have any other questions from the audience before we wrap it up? I realize we've spent pretty much a full hour talking on gold rather than focusing it all on the other precious metals. But
Nikos was primed for PGMs. Come on.
Well, yeah, sure.
Can you talk a little to the supply chain issues we're seeing coming out of South Africa in the PGM space, particularly the mine shutdowns, the strikes?
Yeah.
That would have been my question to him as well, actually. But he told me I can't ask him any questions of that at the beginning.
I told Spencer that too, but clearly he didn't pay attention to that point. Look, I think the one that gets the most attention is obviously the energy supply, the energy utility and Eskom and the problems it's been having. But as you rightly pointed out, that's not the only issue facing South African miners. They have to deal with safety stoppages, copper cable thefts, social unrest. And yes, these are all there in the background. Yes, they are a problem for the companies themselves. I'm not convinced that any of this in this environment is likely to result in any meaningful supply shortage that would, for example, push prices strongly higher. I think there's enough metal around. Demand has been lackluster. The auto producers have quite a lot of stock, and there's metal sloshing around. So I think it's hard to envisage a rally driven by any of these supply chain issues.
I think just on the PGMs, interesting, the reason we sort of have been focusing a bit of late as well as on silver is because the vol is so low in gold that the yields we can get on doing structures on gold, option structures on gold have been pretty poor, right? Compared to cash, right? So we've had to look at down the train at platinum and silver as a way of sort of, I guess, getting some gold proxy. Because we have a bullish 12, 18-month view on gold. So we're just looking for some proxy that has high vol or higher vol that we can then get a better option structure around. And that's really why we've been looking at these things. Yeah.
All right. So to round things out, I thought we could just, have a very quick kind of roundup of, what are you most positive on right now in terms of the commodity space? What's grabbing your interest, whether that's within the precious metals space or outside? Maybe you want to. It's kind of a nice way to round out the program for today. So just outlook for what would be your top pick in metal right now?
Well, we only like precious metals. We hate other commodities. So within precious metals, look, I like. Medium to long term, I like platinum, and more long term, I like silver quite a lot because Platinum is likely going to a period of a few years of deficits, even though there's quite a lot of stock, above ground stock. Eventually that should push the price higher, I would expect. And silver, really honestly, even the most aggressively bearish scenarios that we're building up for silver are showing a market in a perma deficit for the next 5 to 10 years. Look, again, there's a bucket load of above ground inventories for silver. In the short term, it will follow gold and probably be a high beta trade on gold. So we may well see some weakness in the next 6 to 12 months, but long term, eventually all stocks are finite, right? So eventually, as these deficits eat into the stocks, we should see some upward momentum.
Sounds great. Spencer?
Our focus is really in the critical metal space, and that's just a catchphrase. But what we're really talking about is copper. Structural deficit is coming, whether we like it or not, whether you believe the energy transition or not, it's still coming. And copper, of course, drags gold along with it. If you're a copper producer, you make gold. If you're a gold producer, you make copper. And if you don't do one of those two things, then you're not going to be very profitable. But also looking at nickel, where the demand is growing and only projected to continue. And really, some of the smaller critical minerals like lithium, it's saturated now. I think the boom is past or peaked, and you're going to be riding it down. I don't know how far down. So it's really those minerals that are going to be beneficial to the energy transition. Whether you think it goes quickly or slowly, it's coming, and there's not enough production and not enough new mines being built in those spaces.
You've stolen my idea. I thought I was going to be unique, but it's not. I'm a buyer of copper around 8,000. I think copper's cheap, and I think it's cheap for a couple of reasons. Firstly, you look at the IRA Act in the US, and countries around the world are trying to not emulate, because they don't have the balance sheet of the US, many countries, but they're trying to prevent companies setting up in the US. And this is not about the China-US thing or anything. This is just, companies that are coming out of Australia, coming out of Europe, just getting such favourable tax arrangements to build renewables in the US. This is a fiscal fight on a global basis to secure the amount of investment required to upgrade the grid, to fully electrify systems, and so forth. And regardless of whether you're a believer of hydrogen or you're a believer of electrification through, solar or wind or whatever, right? You're going to need additional copper for transition, and governments are going to have to pay for the third hour of storage. Up till now, it makes sense to pay for the second hour, but the third hour of battery storage, governments will have to fund that to some degree to get electrification of the grid high enough to meet whatever climate targets they have in place. And so I just think that copper is, from the demand side, is going to be very strong. And there's no sort of natural replacement to this, right? Battery technology is going to change over time, and that will change the amount of lithium, that'll change the amount of nickel, that'll change these things. But copper, you need that grid investment, and baseload power is different to fluctuating power from renewables, and you need copper to assess with that. Second point I'd make is that most of the supply growth is coming out of countries which it's a much more difficult mining operation, and those operations are going to add a bit more geopolitical risk in as we become a bit more dependent on those new mines delivering enough supply to the market. Can the market solve this? Yes, it can. It can solve it, but it can solve it at 10,000 plus. It ain't going to solve it at 8,000, and that's very clear, right? Gold for me is a hedge. We advocate clients hold about 5% in a balanced portfolio. When we've looked at it over time, clients holding that amount of gold, 2, 3, 4, 5% in a portfolio have had a better risk reward in that portfolio over time. And so even though in the short term, we're not, we have a pretty stable gold price view, we agree on the risk to the downside around the 1850 or so. But around there, the Fed will inevitably cut rates, whether it be in the first half of next year or the second half of next year. ETF buying will come back. That will see gold lift to new record highs, but that may take 12, 18 months to work its way through. Yep.
All right. Well, that seems like a great place to wrap things up. I want to thank our panelists for sharing loads of thoughts on gold as well as the other commodities, and for being in the tough spot of closing out the program for day 2. So thank you.